Hi, it's Frank from CappThesis. Today we'll be looking at the 5 factors that need to occur for the market to undergo a material pullback. And at the end of the video, we'll be looking at an NVDA chart that you won't see anywhere else. So stick around. Okay, let's first start by looking at the drawdowns that took place since the October 2022 low. And there were 3 of them that were substantial enough to matter. 8% down in December 2022, February to March 2023, 9%. And the one we most recently had, of course, from the July high in 2023 to the October low, which of course now we're rallying from. And the most recent one, of course, was longer than the previous ones and steepest as well. And so in terms of what to expect now, if the same type of pullback were to occur, this is how it would appear. And so we first look at really the last major breakout area near 4,600. Very important because that overtook the high from July 2023 and was very close to that high from March 2022, the first major bear market rally we had during that time frame. And pulling back all the way to that zone would be about a 9% decline from there. And framing this from a Fibonacci retracement perspective, the first 38.2 level will be around 4450, will constitute a 12% pullback. So pretty steep, especially compared to what we've had so far, with the biggest drawdown so far being just about 2.5%. So question again, how will this change? Well, the number one thing we need to see is that the market just needs to break this steep uptrend. And it's been testing it now over the last few days. And we're not just talking about moving sideways, even though sideways action would do it. We're talking about a convincing break lower, which of course that would increase the decline from the top, but more importantly, make it more difficult for the market to rally and overtake that high. So really just about, it would increase the chances of a lower high from there. And this is how it appeared, again, looking at the last 3 retracements. And so as we see that once those uptrend lines got broken, that's when the declines picked up. And you'll notice that these retracements aren't as large as the ones we looked at a few slides ago. And that is because really it's very difficult to pinpoint the high of any move, as we know, because all along the way here, it appeared that every time we made a new high and sold up just a little bit, that a lot of people wanted to declare that the end was near. And again, we haven't had a pullback even greater than 3% so far. So why force the issue until we see some more downside follow through? And taking that strategy again over the last 3 times. And so that means that we still were able to get the meat of the decline without trying to actually call the top, because that really has been a losing proposition the entire time. And so number 2, looking at how the S&P does here in relation to its 10-day moving average. So 10-day I picked because the 5-day moving average a lot of people use is very short term, a lot of oscillations around it. This one I think gives us an interesting look because we know on the way down that number 1, the 10-day moving average was sloping lower, making lower highs and lower lows. The S&P was spending the majority of time below the line, and needless to say, any time it went below, it did not lead to a buying opportunity worthwhile until the low. Now, you compare that to right now, much different, of course, with the 10-day moving average trending higher as we would expect, making higher highs, higher lows, and with the S&P spending most of its time above that line, meaning that the periods that it did dip below led to buying opportunities. So if and when that changes, that would tell us that, again, the character has changed and that momentum could be flipping to the negative. Don't see that just yet. Okay, number 3, looking at the trading boxes. We talked about this before, and all along the way, what has happened? We keep on getting resolutions to the upside, and that just means the trend continues to be with us. And we see how this has played out right now over the last 12 months, really, where you had a series of consolidations resolved higher until July of last year when the big reversal happened, and then really didn't get an indication that things were changing right until the downside resolution or downside break below that trading box occurred and you take that all the way to the October low, right? And so if that were to occur, number 4 would be that we finally get a successful bearish pattern. We talk about this all the time. We keep on showing potential versions of this happening. Hasn't happened yet. And so what needs to occur, again, this is just a 2-hour chart. You just need to see a downside break and a downside target hit. Much easier said than done. But again, that can then get the gears rolling in the opposite direction. Exactly what happened on the way up, where bullish patterns didn't work for a number of months. They started to. We've had a number of successful patterns where the S&P hitting its target, consolidating again, so forth and so on. And number 5, we look at this daily price action here pretty closely every day at CappThesis. And one of the trends that we realized has been occurring now for many weeks is that even though you've had instances where there were negative breath days, they don't consistently happen. Meaning that we are working on 2 straight times or 2 straight days with negative ratios. We haven't had more than 2 in a row since November. And early November, we had 4 straight days of negative breath, and then things, of course, took off from there. So with all these 5 factors, none of them have happened so far. If they do, that does not guarantee we're going to get a material pullback, but it increases the chances. More importantly, a material drawdown can't happen with all 5 of those occurring first. And then from there, we'll see how the market can really take a punch. Okay. And so what that means is for the S&P 500 right now, this big bullish pattern continues to be in play. And you may have seen, if you're active on X, that Ryan Dietrich was nice enough to profile this chart a few days ago, and it got a lot of arguments on both sides, whether this is a valid pattern, whether we're going to go that high, whether the market's about to crash, so forth and so on. But really, this is about respecting the breakout from new all-time highs, right? And we know that sometimes the biggest patterns, whether they work out or not, it just takes a long time. So regardless of what happens over the next few weeks, we know we're going to see a lot of different shapes or different setups occur along the way. And so right now, though, if those setups continue to be in favor of the bulls, that we're going to see, smaller bullish patterns form on the way up to 6,100. But if not, we'll not be surprised to see this avoided at some point. We're still just about 3% above that breakout zone. Again, that could occur in 1 or 2 days, depending on the news and in reaction to that news. Okay, on to the video. And so this is a quarterly chart going all the way back to the beginning. I think this is important because obviously a lot of people are locked into this stock and track it intraday, of course, around earnings. We know that's going to be volatile no matter what is going to be on everyone's radar screen. So let's pull back and look at this, in a much different perspective, meaning that this has been in an uptrend for decades. Right? It's had a good run, many good runs along the way. And don't forget as well, there's a lot of chatter about how high the price is. Don't forget, this had 4 different stock splits along the way, meaning that if you got 1 share all the way back here, you would have 48 shares now. So 48 times where it was recently at 700 is about $33,000 a share right now. So something could always go higher. Just keep that in the back of your mind. I'm not talking about NVDA going, exponentially higher from now, but you always have to, take a point of view that things like this have happened in the past and it will happen again. And the other part is that it's up now 6 straight quarters, up about 600% over that time frame. That's a lot, but not nearly as much as its best run, which from the third quarter of 2015 here all the way to the third quarter of 2018 is up 13 straight quarters with a 1,400% gain. Again, just to understand what has happened currently, sometimes we've seen it before, even though a lot of people say we haven't. That's it for today. Check out these videos and subscribe, and talk to you next time. Thank you.